Alexandria Real Estate Equities, ticker ARE, is down nearly 50% this year. A company once considered one of the safest REITs in America has suddenly found itself under pressure. Let me first recap fastly what Alexandria does, and then we get into what happened. And more importantly, is ARE finally a buy at these levels, or is it another REIT value trap? Overview. Alexandria isn't your typical office REIT. They specialize in life science and biotech campuses. Think lab spaces and research facilities, leased to companies like Moderna, Pfizer, and major universities. They own premium properties in innovation hubs like Boston, San Diego, San Francisco, and Seattle. It's a niche, but a profitable one. These aren't cubicle offices. They are laboratories with millions invested in specialized infrastructure. So when biotech industry is booming, ARE thrives. But lately, things have changed. So what happened and what's coming next? ARE was once a fortress, a REIT investors could rely on no matter what. But times have changed, and the cracks are starting to show. The risks are no longer theoretical, they are here. During the pandemic, biotech and life science research exploded. Billions poured into new lab space, as everyone rushed to find vaccines and new medical tech. Developers, including Alexandria, started building like there was no tomorrow. But when the boom faded, those projects didn't just disappear. They were finished. And suddenly there was a massive oversupply of life science space. In 2002, vacancy rates for these properties were around 6%. Today they are close to 27%, especially in Alexandria's key markets like in Boston, San Diego, and the Bay Area. And to be clear, I'm talking about the whole lab space market. So even though Alexandria's properties are high quality, they are competing in a market flooded with new buildings, many of which are still empty or offering discounts just to fill the space. That's where the trouble starts. Leasing activity has slowed sharply, and occupancy has dropped from about 95% to 91% in just a year. Some tenants are even subleasing their space because biotech funding has dried up and R&D budgets have been cut. And political uncertainty isn't helping either. With talks of drug price controls, tariffs, and cuts to the NIH budget, major pharma and biotech companies are pausing new leases until they know what's coming next. This combination, too much new space, weak demand, and uncertain policy, means that the recovery for life science real estate could take years, not months. Alexandria expects a lot of leases to expire in 2026, and re-leasing them might take longer than usual. On top of that, the company's debt levels are rising, and management has already cut earnings guidance. To stay financially stable, Alexandria is selling some non-core assets and might even trim its dividend in 2026 to conserve cash, something unthinkable just a few years ago. So while the long-term picture is still somewhat bright, because biotech and innovation aren't going away, the short-term looks rough. The market needs time to absorb all this extra space, and until that happens, ARE will be fighting strong headwinds. Financials. Let's take a look at the numbers. The forward funds from operations, FFO, the key measure for REITs, is roughly $9 per share. At today's share price of roughly $60, that gives ARE a P/FFO ratio of just around 6. For context, this stock usually is traded at around 20 times FFO in its stronger years. That's a huge compression and a clear sign that investors have lost confidence. Next, the dividend yield, which is over 9%, one of the highest in the company's history. ARE has raised its dividend every year for a decade, from around $2.50 in 2012 to over $5 today. But with cash flow tightening, the payout is now under pressure. Short interest has also crept up. now sitting at around 9% of shares outstanding, showing that more traders are betting against the stock. Meanwhile, the company's market cap has fallen from roughly 25 billion at its peak to just about 10 billion today. Now if we zoom out a bit, revenues and cash flow have actually grown steadily over the long run. Back in 2012, ARE generated about $9 per share in revenue, and today it's nearly $18. But the recent years' numbers don't look too promising. The revenue per share has gone down roughly 4%. In the long term, free cash flow per share has climbed too, from the mid $4 range a decade ago to around $8 recently. Intrinsic value. Let's try to make a rough estimate. The unfortunate reality is that both revenues and FFO are likely trending downwards. But the good news is that much of this risk already seems to be priced into the stock. Analysts expect FFO to fall to around $7.50 per share, representing roughly a 20% decline. With the current dividend, that would push the payout ratio to about 75%, which is still acceptable for a REIT. However, management has already hinted at a possible dividend cut, suggesting they might prioritize debt reduction and balance sheet strength instead. Let's assume ARE can maintain an FFO above $7 per share and eventually return to modest 2 to 3% annual growth after a few challenging years. Currently, trailing 12 months FFO stands around $9. Conservative projection might assume minus 5% FFO decline per year for the next 5 years, followed by 2% growth thereafter. And as always, I want 12% for my money. Historically, ARE has traded at a premium REIT multiples, but it's unlikely we'll see those anytime soon. If the company can stabilize operations and return to growth, the market could re-rate the stock to a P/FFO ratio of 10 to 12. That would imply an intrinsic value of around $70 per share. Alexandria has shifted from being a premium growth REIT to a distressed value story. Unfortunately, the risks have materialized. FFO is under pressure, and dividend cut seems probable. Still, the company's underlying assets remain high quality. And if supply pressures ease and demand returns over the coming years, this could be a high-risk, high-reward opportunity. Personally, I already own shares, perhaps more than I'd like, so I'm not adding right now. But if I were a new investor, I'd consider starting a small position and averaging in if the fundamentals start to improve. I would also closely monitor both bond yields and biotech funding trends if you're interested in the stock. At the current levels, downside risk appears limited. Even with the FFO of $7, the stock would trade at a roughly P/FFO of only 8, implying an over 12% return without growth. And if the company recovers to 8% growth and regains its historical 16 P/FFO multiple, that could mean doubling your money over time. But remember, this isn't financial advice. Do your own research before investing. So, is ARE a bargain or a falling knife? Let me know what you think in the comments. Also hit the like and please subscribe. And as always, do not lose money and safe travels. Bye bye.